Imagine standing at the edge of a vast, unpredictable ocean. You can either choose to navigate those turbulent waters with a sturdy life raft, or you can dive in head first, hoping to catch a wave that will carry you to the shore. That's the essence of trading financial instruments like options and indexes. You can hedge against potential risks or speculate for potential rewards. Each approach has its own unique flavor, and understanding them can be the difference between riding the wave and getting swept under. Let's start with hedging. Think of it as your safety net, your financial insurance policy. When you hedge, you're not trying to make a fortune. Instead, you're focused on protecting what you already have. It's like when you buy homeowners insurance. You hope you never need it, but if a storm rolls through, you'll be glad you have it. In the trading world, this could mean owning a stock portfolio and buying put options on the S&P 500 index. If the market takes a nosedive, the value of those put options rises, offsetting your losses. It's a calculated move that provides peace of mind, especially in volatile markets. Now, let's break down the tools of hedging. Put options are your go-to for protection against price declines. If you're worried about a stock tanking, buying a put option gives you the right to sell at a predetermined price, ensuring that you don't lose everything. On the flip side, if you're short on a stock and want to guard against a sudden spike, call options can help offset that risk. Index futures and certain ETFs, especially inverse or leveraged ones, can also play a role in your hedging strategy. They allow you to take positions that counterbalance your existing investments, creating a more balanced portfolio. However, hedging isn't without its downsides. It can be costly. You have to pay premiums for those options, and if the storm never hits, you might find yourself out of pocket for that insurance you didn't need. It's a trade-off, peace of mind versus potential costs. Now, let's pivot to the exhilarating world of speculation. This is where the thrill seekers come into play. Speculating is all about making bold predictions about where the market is headed and betting on those movements. It's like being a surfer who's scanning the horizon for the perfect wave. You're not just waiting for the tide to change. You're actively trying to ride the wave of market sentiment to profit from anticipated price movements. When you speculate, you're not necessarily holding the underlying asset. You might believe the S&P 500 is about to soar, so you buy call options, giving you leveraged exposure to that potential rise. Conversely, if you think the market is headed for a downturn, you might buy put options or short index futures. It's all about reading the market and making calculated risks, and the potential rewards can be substantial. The tools for speculating mirror those used in hedging: options, futures, and ETFs. But here's where the stakes get higher. When you buy a call option, you're betting that the price will rise above a certain level before expiration. If it does, congratulations, you've just made a profit. But if it doesn't, your loss is limited to the premium you paid for that option. It's a risk-reward dance, and the thrill of potentially high returns with limited capital is what draws many into the speculative waters. But let's not sugarcoat it. Speculation comes with its own set of risks. The market can be a wild beast, and if you misjudge the direction, you could find yourself facing significant losses. It requires a deep understanding of market dynamics, timing, and sometimes a bit of luck. The allure of high returns can be intoxicating, but it's crucial to approach speculation with caution. So, how do hedging and speculation stack up against each other? On one side, you have hedging, which is about protecting your investments, reducing risk, and maintaining a defensive posture. On the other side, you have speculation, where the goal is to profit from price movements, often with a bullish or bearish outlook. Hedging is your safety net, while speculation is your high-stakes gamble. When engaging in either strategy, risk management is key. Always know your maximum potential loss before diving in. Use stop-loss orders and position sizing to limit your exposure. And don't forget about the Greeks in options trading. Delta, gamma, theta, and vega are critical concepts that help you understand how options prices react to changes in the underlying asset, time decay, and volatility. Leverage is another double-edged sword. Both options and futures can amplify your gains, but they can also magnify your losses. A small price movement can lead to significant outcomes, both good and bad. And let's not overlook the tax implications. Short-term gains from speculation are typically taxed at higher rates than long-term investments, which can eat into your profits. Ultimately, the decision to hedge or speculate boils down to understanding your goals and your risk tolerance. Are you looking to protect your existing investments, or are you ready to take calculated risks for potential profits? It's a personal choice, and there's no one-size-fits-all answer. Before diving into the world of trading, it's wise to consult with a financial advisor or conduct thorough research. Knowledge is your best ally in this game, and whether you choose to hedge or speculate, being informed will help you navigate those unpredictable waters with confidence. So, whether you're strapping on your life vest or waxing your surfboard, remember, the ocean of trading is vast and full of opportunities, but it's also fraught with risks. Choose wisely, and may your journey be filled with profitable waves.